we're talking about here, and particularly what is a secondary transaction. And I think when you look across this group, you'll find secondary investors who actually look across all the different types of secondary transactions that we could be talking about here. So a secondary transaction can involve the transfer of an LP interest from one LP to another. That's one type of secondary transaction. A secondary transaction could also involve the transfer of a direct investment from a GP to a direct secondary investor, such as NewQuest or TR Capital. Another type of secondary transaction is actually something which is often called a GP-led transaction, secondary transaction, wherein a GP will organize a liquidity event for all of the existing LPs in a fund through a structured solution. Anyway, with that as kind of the setting in terms of what type of deals we're going to be talking about, I'd like to turn it over to my panel for brief introductions to themselves, starting with Michael, if you wouldn't mind.
Sure. So Portfolio Advisors is a mid-market specialist founded in 1994. We specialize across the private assets, across private equity, private real estate, and private credit. Headquartered in Darien, Connecticut, with offices in Europe and in Asia. Currently, we manage about 38 billion of assets under management, of which roughly an annual deployment rate of 3.7 billion per year. And specifically on the secondary side, we manage around $10 billion. And we again focus and specialize on the mid-market, where 70% of our transactions are below 50 million. We do look at both LP secondaries and GP-led transactions globally, but specifically in Asia, we have executed roughly about 800 million across 40 transactions and predominantly in LP transactions.
Thanks, Michael. Paul?
Hi, everyone. My name is Paul Robine, and I'm the founder of TR Capital. TR was a pioneer in the secondary market in Asia back in 2008, and we started at that time with one office in Hong Kong. Today, we have 5 offices across the region: Hong Kong, Shanghai, Shenzhen, Mumbai, and since recently Singapore. We manage $1.5 billion of assets, and we invest essentially using an active secondary approach at a Pan-Asian level in companies which we consider as innovative leaders in their space or in their country. So that means essentially investing in 3 sectors: technology sector, number 1, digital consumer, number 2, and healthcare, number 3. Today we have a team of 30 people, and we invest exclusively in Asia.
Desmond?
Hi, everyone. My name is Desmond Lee. I'm a managing director with NewQuest Capital Partners. So NewQuest Capital Partners, we started back in 2011. We used to be Merrill Lynch, Private Equity Asia, and we ourselves is a product of a secondary transaction. When we spun out from Merrill Lynch, Obama back then, and formed our Fund 1 through acquisition of portfolio of assets from BAMO back then. Since then, we have raised 2 more funds. We're now into our Fund 4. Total AUM of about $2.5 billion raised over the past 10 years or so. We are Asia-based, Asia-focused. We have offices in Singapore, Hong Kong, Beijing, and Mumbai. The type of secondaries that we usually cover, would be the direct secondaries, as mentioned by Jason. Under direct secondaries, we purchase underlying assets from other GPs, right? From private equity funds or from VC funds, corporates, or even family offices. The other type of secondary business that we do is what we call GP-led continuation fund, where we work with GPs to provide a total liquidity solution for the existing fund by rolling over a portfolio of assets into a new fund, which we will anchor as an LP. So yeah, I think that's a good, brief introduction about NewQuest.
Thanks, Desmond. Just very briefly about me. I'm the founder of Foundation Private Equity. I have the dubious honor of having been around the block longer than these guys, because I've been doing secondaries since 2007, but we are actually the youngest firm here. It's Foundation Private Equity is a secondaries firm that I set up with my partner back in 2018. And we look across the entire spectrum except for direct secondary. So we do LP interest transfers, GP-led transactions, but we do not do direct secondary transactions. Anyway, with that as an introduction and having used up 6 minutes of our time already, let's get into the topic of the day, which is, how has the lack of exits through IPOs and trade sales really stimulated or created additional demand for secondary solutions, and with given the different focuses that everyone on the panel has, I'd like to start with maybe Paul and Desmond to talk a little bit about the direct secondary market, where I guess the interaction with GPs is very face to face, I guess. And Paul, I don't know if you want to start, and Desmond, yeah,
sure, absolutely. Look, it's quite interesting because let's start with one figure. Back in end of 2021, if you aggregate the amount of money which has been invested by private equity and VC firm in Asia that are today 6 years old or more, you have a value of unrealized assets of 523 billion. So what does it mean? It means that these 523 billion US dollar who are owned by funds that are 6 years old or more are going to be sold in the market in the coming 2 to 3 years, because funds will reach their life end. In 2022, we estimate that this figure will be $1 trillion US. So that means the secondary market is growing, and is growing very fast. So all the funds who have different participation in different companies have to sell this big amount of money in the coming 2 to 3 years. So that's why it's interesting as a secondary direct player to be a provider of liquidity to this fund, trying to identify high-quality assets, high-quality companies, leaders in their countries or in their sectors, and companies that ultimately we will manage to exit in the coming 5 years. So that's what we do as a secondary player. One small level of granularity is that we try to focus on fast-growing companies in which we can own a direct stake as a GP, and where we will be not only on the cap table of the company, but we will be also at the board of the company, trying to influence how this company are operated. So that's, to answer your question, Jason, what secondary direct means.
So Desmond, do you want to just comment in terms of deal flow and what you've seen in the direct secondary space now that we've set the scene, or Paul set the scene?
Sure. I think just a bit of context, right? I mean, even before the slowdown, right, that the market is currently seeing, I agree with Paul, and I think the level of unexceeded assets in Asia, based on our estimate, in total quantum is about close to $1 trillion, right? And that would only continue to grow, right? Because the level of primary capital being invested will always sort of outstrip the level of exits that GPs may be able to generate. And I think from our perspective, when we first started, our focus has mainly been on direct secondaries, right? Providing additional options and paths to GPs, in addition to the traditional path like IPO and trade sale, right? And I think over the past, 2 or 3 years, after COVID, we have definitely seen more deal flows in direct secondaries from both the PE side and the VC side. I think especially in Southeast Asia, we have looked at increasingly more pipeline coming from the VC side, right? Because of the maturing ecosystem in Southeast Asia. Because in Southeast Asia, most of the VC funds, the first fund are usually, I think, 2012, 2013 vintages. And this is the time when, VC funds, they would sort of start showing liquidity and DPI to the LPs. That's why over the past 24 months or so, we definitely see more deal flows coming from the VC side. In addition to what we continue to see in the PE side as well.
So maybe looking at a slightly different perspective on the how that unexited NAV could be released. I mean, one way is obviously for GPs to sell to groups like NewQuest or TR. Another option would be obviously for the LPs themselves to make that decision to exit, right? Because there is an established market for LP interest transfers now. I think $60 billion a year or something like that. I think global volume. Michael, could you just talk a little bit about that? How the slowdown in Asia in terms of kind of IPOs and trade exits. Has that stimulated additional deal flow, in your view, in terms of LP interest transfers?
Yes, and I think this is just the start of a very interesting opportunity set for investors looking at LP secondaries. And why is that the case? Whenever there's a huge wave of market volatility, I think the secondary LP interest market takes a moment to correct, because if you look at the time of the reporting, there's always a lag effect and does not really reflect the tremendous or significant mark-to-market movements if there's a significant public component within the portfolio. So usually it takes some time for the selling LP to really understand what's the real mark-to-market value of the portfolio and then decide what's the right price that they want to sell. Similarly, from the buy side, you need some time to really factor in the various pieces of information. And I think we have seen this before. Not saying who really knows what exactly is the economy going to perform, whether is it the GFC, 08, 09 period all over again. But during that time, there's another important factor that really drives up demand or supply of secondary opportunity, which is the base effect. I think one may not notice is that when the stock market has a significant correction, the public portfolio becomes significantly larger or lesser than the private portfolio, and a lot of investors will therefore have to trim down their private assets to maintain or keep their portfolio within the allocation that they target for. So I think that is another opportunity that if this current wave of market correction continues, I think it's going to drive up deal flow significantly on the LP side.
Okay. Let's spend a little bit of time on GP-led secondaries. In some senses, that's a part of the market where I think some of the people in the audience might be a little less familiar. A GP-led secondary, in a way, is somewhere between an LP interest transfer and a direct interest transfer to a direct secondary player, right? So, for example, you might have a GP that is managing a fund that has come to the end of its life. There are remaining assets in that fund, and instead of trying to sell all of the assets in one go, the GP will actually arrange for a liquidity solution for all of their LPs, right? So the GP would set up a new vehicle called a continuation vehicle. That vehicle will be funded by a new set of LPs, mainly secondary LPs, but that GP will actually manage the continuation vehicle. So effectively what the GP is doing is they're providing additional runway to a fund that's come to the end of its life, right? So that's a classic, I guess you could say, GP-led secondary. We've seen a lot of those in Asia in recent years. In fact, I think today, I don't know, by number at least, GP-led transactions seem to be picking up quite significantly. Maybe, Desmond, you completed one which was quite public recently. Of course, I won't mention which one it was, but there was a big exit coming out of that deal, which was a very successful one. Could you just talk a little bit about GP-led secondaries in Southeast Asia and how you see them as an alternative to, kind of downstream trade sales and IPOs, and indeed direct secondaries?
Sure. No, I think if we were to put secondaries sort of transactions into two buckets, maybe we can do that, right? The first bucket would be the single asset exit, right? For example, IPO, right, or trade sale, or even direct secondaries, right? Typically, we do that on a single asset basis. While for GP-led structure, as mentioned by Jason, right, it tends to cover a larger sort of portfolio of assets, right, multi-assets. And I think from our perspective, we have been sort of in the market, sort of engaging with GPs, right? Because when we go to a GP in trying to structure a liquidity solution for the GP, right, the first thing that we will think about is, what are the motivations, right? And whether a direct secondary makes more sense for them or a GP-led structure makes more sense for them, right? And I think over the past 2 years or so, especially in Southeast Asia, we have definitely seen a pickup in GP-led transactions. One, because it involves a portfolio of assets, the quantum of distribution back to the selling fund and the LPs, right, it's usually much more meaningful than just say a single asset exit, right? And then we've sort of seen precedents of transactions being done in Southeast Asia. So that's one. Two, I think a lot of time because COVID sort of, or even delay in exit as well, right, or market cycles, allows the GP to start thinking about, what are the liquidity options that is available in the market, right? Because, for example, let's say COVID, there are good quality assets out in the market, for one reason or another got impacted by COVID, and the GP may then say, okay, do I need to sort of sell the asset now just because I need to return liquidity back to the LPs, or should I think of a more creative structure to return a more meaningful liquidity to the GPs, right? And GP-led structure is meant to achieve that because we'll work with the GP and roll over a selected number of assets from their existing fund to a new fund, which we will anchor as an LP, and allow the GP to return again a meaningful liquidity back to the LPs, right? And the GP will continue to manage that portfolio. So in our mind, it's a three-win sort of structure because GP get to continue to manage and enjoy economics and upside, post-transaction. LPs of the selling fund, would get almost, bulk of the liquidity from the transaction, and we of course get to, partner with the GPs in investing in those portfolio.
I want to let Paul jump in here with his views on these sort of transactions. I mean, what have you seen in the last 12 months, for example?
Sure. So the GP-led situations have been interesting, and they have clearly developed quite a bit in the past 3 to 4 years. However, a lot of them are not necessarily good in the sense that they sometimes involve funds that are 8 or 10 years already and who are just trying to extend their life by a few years in order to retain their existence. And that can be a problem. So I'm not saying all the GP-led situations are bad ones. It's not the case. But the reality is that the majority, you need to really ask yourself, why is the GP doing this? So at TR Capital, we tend to prefer what we call buyers-led situation, where typically you identify a fund that has got assets for sale, and you cherry pick 2, 3, 4, 5 companies that you acquire from them, and where either you will become the GP with your team, or where in certain instances you will retain the GPs, but it has to be with very clear milestone on the exits and very clear definition of targets early in the deal, so that you don't end up being stuck 3 to 4 years after. And in these instances, there is a bit of a difference between Asia and the US or Europe, in the sense that in Europe, in the US, most of these GP-led, the underlying companies are controlled by one fund. Here, it's still a market of minority positions. And as a consequence, the nature of GP-led makes it a bit more complicated to operate. So again, interesting opportunity, but the bar should be very high in order to make this GP-led a success.
Mindful of time, I just want to maybe take the conversation in a slightly different direction, which is, again, even though we're here in Singapore, actually, it's an observation I'll make, which is the center of gravity of the secondaries world has actually decidedly shifted to Singapore now, because up here on the panel you actually have, sorry, Desmond, you were in Hong Kong too. We were all in Hong Kong until quite recently. In fact, Paul was here, you arrived a month ago, Michael 2 years ago, Desmond about 2 years ago, I 6 years ago, and we actually all moved from Hong Kong to here, so I can say that Singapore is now the center of the secondary world in Asia. But we actually all have, our firms at least have Pan-Asian perspectives on the secondary market. So could you guys comment, in turn, in terms of where you think the most interesting opportunities are in terms of secondaries as far as valuation, if you could comment on China, especially given how China at the moment is, I guess, lower on a lot of people's priority list. If you're a Pan-Asian investor, people are spending more time in Southeast Asia. India comes up again and again. But yeah, if you guys could maybe comment on the regional, the country divisions or differences.
Yeah, maybe I can start because I think you're exactly right. Historically, China is probably the biggest aspect of our portfolio, along with Pan-Asia regional funds, when we talk about buying LP interest stakes. And today, I would say it's not that we are shy from China, but the price does not present a very attractive risk-reward in our opinion. And you're just an example. Recently, we have seen a couple of China-focused funds trying to ask for a price that's significantly higher than a transaction that we are closing on the Pan-Asia side, which is very, very diversified, control transactions to a point made earlier by Paul, vis-a-vis minority growth investments, diversified across both in terms of number of companies and also different regions. So I think it's definitely tricky to talk about China today, but at the right price, there's always a good risk-reward balance. So we have yet to really see that in the opportunities today. So when we look at the markets, I think right now we do see good opportunities in the regional funds. And we do buy from Western-based sellers, which is looking for a solution for a global portfolio. And that's where we do find unique opportunities for the specific Asian assets, which is probably a small part of the whole portfolio, and therefore we find a very interesting risk-reward in those instances.
Paul, you want to make some comments?
So I'll try to be concise between China, India, Southeast Asia. China corrected a lot, particularly on the public market, as everyone has seen, and particularly in the tech space, where valuation of certain public companies decreased by 60% plus year to date. That makes it a very interesting opportunity from a valuation standpoint. And I would say once we got some clarity on the change of leadership, on the geopolitical aspect, China remains the second largest economy in the world, soon the number one. And from a pure secondary standpoint, the coming 12 months to 24 months should become interesting if you take a 5 years view. India is a bit different. India is still very richly priced, particularly from a PE standpoint. PE valuations remains high.
Do you mean private equity or PE?
Private equity valuations, yeah, absolutely. Public markets are cheaper than private markets in India, which makes it interesting from one perspective. At least that's the one we see at TR Capital, which is the new economy, companies that are in the digital space, companies that are in innovative healthcare. These are where the opportunities are. Finally, and I will wrap up with Southeast Asia. Southeast Asia, the opportunity, we see it from all the VCs that were created in Singapore 5 to 10 years ago, which today have invested, have in their portfolio companies in which they invested 5 to 7 years ago. These were startups 5 or 7 years ago. Today, these companies are leaders in their space, are very innovative, and the VCs are trying to look for liquidity. There is a win-win situation in providing them with some liquidity on certain of their best assets, and that's an interesting opportunity in our view. So all this to conclude that perhaps the market from a secondary standpoint has complexified quite a lot. Today you can't do secondary in a proper manner from just an office in Hong Kong or in Singapore. You need to have local presence in many different markets with large teams and people coming, if you can, with a direct investment background. And that's how you play your edge.
Desmond?
Maybe I'll just add on to the Southeast Asia a bit. I think when we first sort of start engaging with GPs on GP-led solution a couple of years back, I think it's fair to say that there were a lot of cautiousness by GP, right, in terms of what can these GP-led secondaries bring to the table, right? Because there will obviously be questions on the execution risk because we are transacting on the larger portfolio of multi-assets, right? What would it mean from the LP perspective, in terms of a GP bringing to the table a GP-led secondaries and so on and so forth. So I think in Southeast Asia, as mentioned, we have definitely see more precedents of GP-led secondaries being done in the market, and that would only sort of solidify the value that GP-led secondaries can bring to the table, where LPs like ourselves, secondary firms like ourselves, we can execute GP-led of a portfolio transactions where we do diligence, in parallel, right? So people have seen how it's done. People can see how economics are being shared with the GP post-deal. And I think as mentioned also, increasingly we're seeing more funds coming to the end of fund life, funds needing to sort of go back to the market to raise new funds, and they needed to show meaningful DPI. And GP-led, of course, will bump that DPI quite meaningfully because it's a portfolio transactions, right? So from my perspective, I think Southeast Asia, we are at a stage where we are, I wouldn't call it a tipping point really, but definitely is a stage where we're getting more engagements from GPs wanting to know more about what GP-led secondaries are and what does it encompass.
And
I do welcome questions.
if I may add just one point which is interesting on Southeast Asia to complement is, if you look at the IPO market in Southeast Asia, it's less deep than what you can see typically in Hong Kong or in China. And that's an interesting point because it creates a need for secondary players like us, which is bigger. And I think all the VCs start to realize that IPO is not the only exit for companies. Trade sale is one, but also a sale to a secondary firm.
We received a question from the audience, and I'm really glad. It's a very thoughtful question, too. So I'm going to throw it out to the panel. Can you share more details on how valuation is negotiated for GP-led secondaries? I don't think the question is how pricing is determined, it's how valuation is negotiated. Maybe anyone want to take that?
I can take the first shot at it. I think for GP-led secondaries, I think we can see from both sides, right? The buyer and the seller. Buyer meaning the lead secondary firm, funding that continuation fund, right? And because as a LP, they will be paying fees and carry to the GP, right? So any pricing that the secondary firms need to underwrite the transaction at would have to incorporate that, right? So that would mean that a secondary firm wouldn't be able to pay a normal value that a single asset would command just because an LP would need to pay fees and carry. So that's from the buyer's perspective. Now from the seller's perspective, I think consideration would need to be given to the fact that the seller is getting bulk of the money back today, right? So instead of next 12 months, 24 months, or 36 months, if they were to sell each asset on a single asset basis, right? So there will always be consideration of time value of money because they're getting all the distribution back today. So I'll just leave it as such because both buyer and seller would have to consider those, and usually that's how pricing are determined or negotiated for GP-led secondaries.
Yeah, I'll just maybe add to that, which is, in a sense, because the GP in a GP-led deal is actually kind of conflicted, right? Because they're both on the sell side and on the buy side. A GP, in a sense, can't act as a fiduciary of the selling fund because, as much as, of course, they will have external legal counsel making sure that they're negotiating the right terms on behalf of the selling fund, there is a conflict of interest, which effectively means that the buyer in a GP-led deal, the lead investor, is often really not negotiating with anybody except for the market, right? You're really competing with the pricing in the market, whether that's for comparable companies, but of course also if there's a process being run for the GP-led deal. So in a sense, we're not really negotiating with anybody. We're just kind of making sure that we're setting a clearing price that sufficiently motivates the GP and the LPs on the other side of the table, well, certainly the LPs on the other side of the table, to actually support the transaction. I'm going to go on to the next question. I love the fact we're getting questions. Can you comment on the quality of the liquidity exit provided by GP-led secondaries? There is a question in there of the question.
An interesting one, because I think it's probably asking from the viewpoint of the LP.
Correct.
Yeah.
How do LPs view a GP-led secondary? If you're a GP considering a GP-led secondary, how does that affect your track record, right? And maybe Michael, you can take this because you're more from the LP secondary perspective, and you do primary investments actually as an LP as well.
And interestingly, we have both accepted your proposal to sell through a GP-led secondaries and also decide to remain as an investor in the GP-led process. So we have done both historically. And I think from our standpoint, it's really a bottoms-up analysis on the portfolio. I think the most of the time we will be receiving a comprehensive solution for a bulk, if not the full portfolio that is remaining, that's continued to be held by the GP. And the analysis that we have to make is whether the price is a fair value. Jason, to your point, there is an inherent conflict of interest. And we have to therefore do a bottoms-up analysis and have a view on the pricing, have a view on the exit timing. There will be some guidance from the GP, and really decide whether is it a better outcome for us to sell or to hold. So it really depends on the situation. And I think the market is sophisticated enough today that there's a very, very good amount of information and third-party information as well for LPs to really form a very informed views on whether the offer is attractive or not.
We're getting another question come in, which is great. This is a very interactive panel, which is unusual for secondaries. Usually we don't get that many questions, so I'm really happy. I'm going to read this out loud as the question's coming in. There have been transparency concerns around continuation funds. How do you address these? And let's actually focus on one type of continuation fund, because I think this is especially relevant, and we were talking about it earlier, which is single asset continuation funds, right? So, these GP-led transactions have evolved, and of course, the market being as efficient as it is, it's evolved to the point where you actually have single asset continuation funds. So a GP will actually effectively replace his LP base in a single asset, quite often the jewel in the crown, right? So, this question of transparency of price, or I guess just in terms of the continuation fund itself, and I suppose it's not just price, it's also GP alignment, right? Economic alignment, whether that's, the terms that the GP is getting, both fees and carry in the continuation fund. How do you see that in single asset deals, Paul? And what do you think GPs can do as they think about these sort of continuation vehicles to help, enhance transparency in the process?
Absolutely. So on that part, there is quite a big difference between the US market and the market we see in Asia. And this is due mainly because when you go to the US, generally these continuation fund of single assets are in one underlying company which is controlled by the GP who is leading the transaction. And that creates a justification to extend through a continuation fund. If it's a minority stake, then I would say that the bar becomes again much higher to be a success, because there are exceptions, and we would know that. But in general, it's much more tricky because it's just a way for the GP to extend the life of a fund that they did not manage to exit under a certain timing. In a way, it's like if you have a company and a CEO who underperforms during 10 years, and he calls you and tells you, hey, give me 2 more years, you will see in 2 years things will go better. Generally, it does not work. So it's the same for a GP. again, last point, it's all about how you will structure the deal as a newcomer in the continuation fund and how you align interest with the existing GP. So it's not only about economics, it's also about the corporate governance and redrafting the LPA to ensure yourself that you have rights to exit and you define clear targets pre-deal. In this instance, it can be good.
I'm going to jump in at your invitation, actually, Paul. We've run out of time, but clearly, you have a bunch of guys up here who are experts in the field, and I would encourage anyone who has further questions to approach any of them, if you can catch any of them after the panel. But I just wanted to say thank you to Michael, Paul, and Desmond for your time today, and also to Deal Seed Asia for the invitation to join this panel.